Hi everyone, welcome back. So every real estate investor obsesses over the return on their properties, but almost no one talks about the return on their cash before they actually buy the property. If you're saving for a rental, your money shouldn't be lazy. It should be working while you wait, ensuring that it doesn't drop 30% in value due to a market downturn. So in this video, I'll be discussing some options for where you can keep your down payment funds when you need the money in the next few months to next few years. And also where not to invest your money in the short term, because the wrong place can cost you thousands before you ever close on a deal. And just a quick note before we dive in, the best spot to park your money changes as interest rates and the economy changes. So what makes sense today might not be the top choice a year from now. So let's go over the best places to keep your cash safe, liquid, and still earning a little bit of return while you wait for the right deal. First up, high yield savings accounts. This one's the simplest and probably the best option if you're planning to buy within the next few weeks to months. A high yield savings account is just like your normal savings account, except it actually pays you real interest, usually around 3.5% as of the writing of this video. They're FDIC insured up to $250,000, and you can access the money instantly. If you're sitting on 50 grand for a down payment, a regular bank account might pay you $5 a year. A high yield savings account though, you'd earn around $1,700 in interest at 3.5% over the span of a year. That's your inspection and appraisal fees all covered just by parking your money in the right place. And the best part is it stays liquid. If you find the right property tomorrow, you can move that money over instantly. Now, if you don't think you'll be buying for a few months, then Treasury bills or T-bills might make more sense. T-bills are short-term loans to the US government. You lend them money, and when the T-bill matures, the government pays you back plus a little extra. T-bills come in 4, 8, 13, 26, and 52-week terms. Current rates for T-bills yield around 3.75%, and they're backed by the US government. Now, I know what you're gonna say. I don't trust the government to pay me back. Well, the US government has never defaulted on its debt because they have the ability to do something that you and I don't, which is printing money. Now, obviously, this isn't good from an inflation standpoint, but at least you know you'll get your money back plus interest. Another great thing about Treasury bills is that there's no state income tax paid on the interest. So if you're not touching your money for a few months, these are one of the safest investments you can make. Next up are certificates of deposit or CDs. Think of a CD like a deal you make with your bank. You agree to leave your money there for a set time, maybe 3, 6, or 12 months, and they give you a fixed interest rate in return. The trade-off is that you can't touch the money until it matures without paying a penalty in most instances. But if your goal is to slowly build up a rental down payment and you're not planning to buy for some time, then that could be fine. You can even build a CD ladder where you spread your cash across different time frames so money comes due every few months. That way you're earning higher interest without locking yourself out of your cash completely. Now, if you're in a higher tax bracket, then municipal bonds or muni bonds can make sense. When you buy a muni bond, you're basically lending your money to a city or state. In exchange, they pay you interest, and that interest is usually tax-free both at the state and federal level if you're a resident of that state. Munis typically make the most sense for people in higher tax brackets because the interest rates on these tend to be lower than other investments due to the tax advantages. You would have to compare the interest rate you're getting on a muni with the after-tax return of other options such as Treasury bills and CDs. Munis are tax efficient. There is more risk to them because states and cities can't print money to cover their obligations, meaning you want to be aware of the financial strength of whoever is backing that muni bond. A great example of this was Detroit in 2013 when the city declared bankruptcy and wasn't able to pay out on their bonds. So we discussed some options for what to do with your savings, but now let's talk about what not to do with your down payment. First, please, for the love of cash flow, do not put your down payment money into crypto. I don't care how confident you are that it's going to the moon. You don't want your duplex fund dropping 20% in a week. You can't explain to a lender that you had the money but Dogecoin dipped. As an example, Bitcoin dropped almost 70% from its high in 2021 and didn't recover until 2024. You also don't want to put your down payment money in the stock market either. The stock market is great for long-term investing, but terrible for short-term goals. You could get lucky and be up 10% one month, but then down 20% over the next few months. And while we're on the topic of what not to do with your rental savings, let's talk about gold and other precious metals. I get why people bring it up. Gold feels safe. You hear it holds value or it's a hedge against inflation. That's all fine in theory, but the reality is gold is a speculative investment, not a savings vehicle. Its price moves every single day just like a stock. If you're saving for a rental, volatility is your enemy. You don't want to wake up one morning and find that your down payment fund is suddenly worth 10% less because the metal market dipped. When you're saving for a rental, the goal is not growth, it's preservation. You want that money safe, earning something, and ready to move when the right deal hits the market. So here's a quick recap. If you're saving for a rental, then options such as a high yield savings account, treasury bills, or CDs can be great. In addition, muni bonds can be a good option for those in higher tax brackets, but you really want to make sure that the state or city backing them has strong financials. As for assets to avoid, assets like crypto, stocks, and precious metals aren't good options due to the volatility of these markets if you're looking to buy within the next few months to couple of years. This is how you protect your future down payment money while keeping it productive. Alright, if this helped you and you want to learn more about financial planning for real estate, make sure to subscribe because I've got a lot more coming your way. Thanks for watching, and I'll see you next time.